speaker series. We hope to bring relevant information to our entrepreneurial community, and financing is certainly on the top of the list of concerns for entrepreneurs. Back in January, we had a financing forum where we focus on venture capital, SBA loans, and other government funding such as Small Business Innovation Grant. But today we're going to focus on a few other capital resources, and I think resources where a lot of our entrepreneurs are not aware of. We have a great panel with experts in different areas of capital. I'm just going to briefly introduce our panelists. We have Kelly Northridge, who is the co-founder and a managing partner of Audacity Fund. We have Molly Otter from Sage Growth Capital. We have Ed Vento from Prestamos, and then we have Shavonnah Collins from Southern Nevada, and who has been an educator as well as an entrepreneur herself. Thank you all for joining us again. And I think we'll start off with Kelly. Kelly, just tell us a little bit about the mission of Audacity Fund, and what is the population that you hope to serve?
Sure. Thank you very much, Grace, for the introduction. And the Audacity Fund Reno is building a vibrant and inclusive local economy by providing funding, education, and support to business owners from underserved populations. We are a proof of concept fund, which means that we invest early in companies where $50,000 or less would make an impact and growth. That we invest both in the tech companies that we think of in terms of venture capital, but we also invest in Main Street, again, really looking towards our local economy. We focus on appropriate capital, meaning what type of capital is right for the business that comes through our program. So with that said, we offer grants, we offer standard debt and equity financing, but we also do alternative debt and equity financing, which is the instruments we use the most of right now is revenue-based financing, which I'm sure we'll talk more about later. We focus on credit-based rather than character-based rather than collateral or credit-based. And we have two criteria. So for the Audacity Fund Reno, you need to be based in Northern Nevada or the Lake Tahoe area. And you need to be an underestimated founder, meaning woman, minority, veteran, LGBTQ, return to work, etc.
Okay, great. So when you talk about character-based, what do you look for in an entrepreneur or business owner in order to make that funding decision? What are you looking for in the team, in the person?
Sure. So we invest early, which means we know things are going to change in a business. So a wonderful idea sitting in front of us most likely won't look like anything that it did the first time we talked to you when it's actually out and running and successful. So with that said, we actually focus most on the passion of the entrepreneur. And if we think they're really going to build something great, that is all the entrepreneur themselves. Is this their passion? Is this what they want to do? How do they see the future? What does their impact look like, not only for a company, but also for themselves as well? So are they the go-getter that's just going to go out there and make something happen?
Okay, great. So in that sense, it's similar to venture capital, where especially early on, you invest in the team.
Yes,
whether
absolutely.
Has a passion and ability to execute.
Mm-hmm.
Now, for some of the first-time entrepreneur, they may have the passion and the willingness to work hard, but don't have all the tools and the know-how. Can you tell us a little bit about how you will provide education and mentoring, perhaps through the Audacity Institute?
Yes, absolutely. So the Audacity Fund has an additional entity called the Audacity Institute that is there for education, training, and support. And brand new founders is fantastic. We can teach you all the strange little terms that are thrown out there for entrepreneurs and in the finance industry, and you bring your passion. So we focus on a lot of different areas. Even seasoned entrepreneurs definitely don't know it all. So we have all the standard areas in business where we offer education series from finance to marketing, etc. But we also focus heavily on showing the funding spectrum and thinking about our businesses from the very startup, even when it's napkin stage, all the way through how you want to end the business, focusing on that appropriate capital for the way you want to grow, and also the different ways that you can fund it along the way.
Okay, great. And so, you mentioned a number of the underserved populations. And what are some of the reasons why female founders and minority founders and some of the other underserved entrepreneurs have limited access to capital? Is it because they don't have the relationship with the banks or the VCs? Are there any underlying structural issues that we need to address?
I'm so happy you asked that, Grace. The short answer is that there is systemic bias that's literally built into our financial system. And it's perpetuated and it continues through the training of new investors. So literally our entire economy is built for this bias, which is really frustrating when you're sitting on the other side of it. Has a woman or a minority or intersectionalities in there of done something to not be able to get the financing that they want? A lot of times, no, that's not the case. It's these sadly, these systemic biases that exist. So one of the additional areas that we work on in Audacity is actually helping change that conversation with investors. So what is pretty amazing about entrepreneurs that sadly fall into the systemic bias is that we're able to do more with significantly less. So national statistics are that for every dollar that a white male business owner gets through any capital means, a woman or minority-owned business owner, if they get the capital, gets 33 cents. So there's a huge discrepancy in that, and yet we're still able to create thriving companies against those types of odds. So we bring together new investors and show them the capacity that is there. And then we also, for investors who've been investing for a long time, who are open and willing to learn, we provide training on all of the different ways to look at these approaches that have been perpetuating these norms.
Okay, and so how's our local community in Northern Nevada, or maybe just Nevada as a state, compared to the national stats? Are we better off, worse off, or about the same in terms of serving these populations?
It depends. For the most part, we're the same, but in a couple of different categories, sadly, we're actually worse. So just a few statistics to set that tone is that less than 0.5% of monies go to Latino founders, 1% to Black-owned businesses, 2% to women-owned businesses. That statistic, sadly, has not changed in over a decade. So we're working hard, but things aren't quite moving the needle. In Nevada, we actually have a nascent venture capital arena. We're talking angel investing. We've been working on that over the last few years, but we still have a long ways to go. So a lot of the entrepreneurs that we work with actually have to go outside our state in order to find values-aligned investors. I think that'll change, but right now we're a little bit worse in that category, unfortunately. When it comes to other statistics, we actually just recently did an analysis of the PPP loans. Nationally, 12% of minority-owned businesses actually received PPP loans. In Reno, it was 14%, so we are slightly better there. Unfortunately, though, we matched or exceeded statistics when it came to that ratio of dollars that went to various groups. So our local Asian population and entrepreneurs got 12% less money, Latino population 15% less money, our Native Americans 55% less, and our Black entrepreneurs 60% less than our white-owned businesses just right here in Reno with our PPP loans.
Great. Well, thank you, Kelly. So moving on to you, Ed, you're with Prestamos, which is a community development financial institute. And could you tell us a little bit about the mission of Prestamos and what is a CDFI? How is that different from a bank and other lenders? You're on mute.
How's that?
Good.
You hear me now? So a CDFI basically is similar to a bank, but we don't take deposits. We're not a depository institution. Several CDFIs have different missions. Most of them are 501c3s. There's a few of them out there that are not. We are a 501c3. So our main mission is to stimulate the economy and create jobs within disadvantaged neighborhoods and communities. So we focus very much on minority lending, startup transfer from businesses to within that, we're also NSC award, we're chartered by U.S. Treasury to do what we do. We also provide business coaching from the very beginning of a business. And we have currently at our company, we have 19 subject matter experts that'll cover everything from your QuickBooks to your marketing to social media to if a business needs an app built, we will build that for them, all at no cost to the business. It's all paid for already.
Great. Sorry about that noise. Not sure what that was. So what is the population or target demographics, the type of business owner that you're hoping to serve? Both geographically and type of businesses and, the distressed community, for example.
Right. It's actually very similar to what Kelly is doing. We're really focused on minority lending. We don't restrict it to just that. But we're focused on that. We're focused on disadvantaged communities. We focus a lot on areas like, say, in Reno, where we see 20% or more poverty rates. Within that, though, we are a collateral and cash flow based lender. We do look at projections, though. So if you have a startup business, you've been to every bank in town, they're all going to say no, likely. We will look at it and we'll lend based on projections, and we will assign coaches to you to work with you. So pretty much when you start working with us, you inherit a whole organizational chart to be able to ensure your success.
Yeah, so you mentioned collateral. So one of the things about entrepreneurs seek bank loans, sometimes they have to put their house as a collateral. So what kind of things do you take as a collateral?
Pretty much whatever will work for that certain deal. Some people have put up vehicles. Some people have put up tools. It just kind of depends what we can put together. We don't have any grants right now as of yet that we can just say, here. But we have noticed that our default rate has greatly reduced since we started asking for collateral by just a multitude of percentages. And so we're sticking with that model. But just about anything will work, right? In some cases, we've had relatives that chip in and, will put in CD, put up their house or other types of collateral. So.
Okay. And so how are you different from the bank in terms of the cost of capital to the business owner? Do you tend to have a lower interest rate, about the same? If someone already have access to a bank, what's the reason maybe going to a CDFI?
Well, sometimes they want the business coaching. They want that marketing support, everything else that comes with it. We are an SBA micro lender, so we will do $50,000 to $10,000 loans. Anything under $10,000, we'll kind of look at it, but usually we'll work with other partners like Opportunity Fund or Dream Spring, or hopefully Kelly's group here, if we connect here. How are we different from a bank? Basically, our rates aren't going to be lower, right? Usually when you're doing a startup loan, you're doing a higher risk type of loan. In essence, what we're really doing is we're borrowing the money ourselves from the bank, right? I'm simplifying this, but in the grand scheme of things, we're borrowing the money from the bank. And then we're posting the guarantee saying, hey, look, we're going to pay this money back at this particular time. And we're able to lend out that money. And so we're going to put a premium on that to make sure that costs are covered. So, it could range. Right now, it would range anywhere from 7.25% to 9.25%. Some of our other loan products are 5.1%. It just depends on what the project is and the strength of the project.
Okay, great. Thank you. And Molly, so we'll move on to a kind of a different subject and often considered as growth capital. And I think it's a subject that a lot of us are not that familiar with, but it's not new at all. So could you tell us a little bit about what revenue-based financing is and how is that different from the traditional debt?
Sure. So revenue-based financing involves taking a percentage of revenue every month from the company in order to pay back at a certain multiple that's set at the beginning of the investment. And it's different from a bank in that it fluctuates based on your revenue. And in our case at Sage, it's net cash receipts. And that's generally how people do it in the revenue-based financing world, because that's an easier number to look at, right? That's the amount that you've got from your customers in your bank account that month. And you're going to pay a percentage of that towards your overall multiple that you owe back. And those multiples range from usually 2 to 3x. Sometimes they're lower if you're a well-established business. Sometimes they're higher, but depending on how the payments are structured and how the company's looking at it, if it's longer term investment. And it's revenue-based financing is newer to this space, and it's kind of people are trying all sorts of different ways of doing it. At Sage, we say that we're doing like the plain vanilla version, which is we just take a percentage of revenue. Once you pay our multiple back, which for us is between 2 and 3x, the investment is complete. We don't do any personal guarantees. There's no collateral. We're not doing any warrants or any equity. And we structure it as a convertible note. So it's a little bit more equity-like because it's a convertible note, but it's really just an more traditional loan on your balance sheet. People are looking at all sorts of different ways of doing this. Sometimes they're doing like a buyback of stock as part of it, like a redeemable stock purchase. That can be really hard for businesses because you have to have positive equity on your balance sheet in order to accomplish that. And a lot of the companies that we look at Sage are losing, net income negative. And so they don't have that ability to have positive equity. So we structured it as a convertible note, and we don't take any equity because we think the 2 to 3x return for us covers all of that risk on our end.
Okay, great. Now, because you're taking a percentage of the revenue, obviously this probably is not a good fit for a low margin business. And so if you could tell us maybe what would be the ideal candidate for this type of financing, and maybe for Sage Growth Capital, what is your investment space? What type of high margin business do you invest in?
So high margin for us is anything over 40% of gross margin. And we want you to have a consistent gross margin. So it shouldn't be volatile every month, because the way revenue-based financing works the best is if you have consistent margin. And as a result of that, when we take a percentage of the revenue, we're not impacting your underlying SG&A that's in your business, right? If you're volatile on your gross margin, then that can be a real problem for the SG&A if we're taking a percentage of revenue. So we should be able to keep that kind of consistent throughout it. Sage is really focused on any industry where there's some type of recurring nature to the revenue. And historically for revenue-based financing, that's been SaaS technology. And that's what I did at Lighter Capital, was all SaaS technology. But at Sage, we've actually looked at a bunch of stuff, and our first 2 investments have been in food businesses that are selling through retail, like your traditional Albertsons or QFC or anything like that, because they can show you the turns on the shelf, which is just the same as kind of a recurring revenue stream that you would maybe see in a SaaS model with customers paying you on a monthly basis. So we are agnostic industry-wide. We just want to make sure there's some recurring nature. One-time big project companies are not going to work well for this type of financing.
Yeah. So you mentioned SaaS, these are software as a service type of companies. And you talked about having a return of 2 to 3x, meaning that once the cumulative payment has reached 2 or 3x, which is set at the beginning of the term, that's sort of your target return. How do you decide whether it's going to be more toward 2 or versus 3? Is it because of risk level or the entrepreneur?
It's definitely risk level of the investment, right? If you think that that this investment is riskier, you're going to aim more towards 3, because you want to make sure that you've got some upside on your return if it doesn't happen for you. And we, like Kelly, look at the entrepreneur and judge their character and say, if this seems like this guy's got it, or guy, woman, whoever has it under control, then probably on the lower side, because they're a less risky investment for us. And often also the contracts, like how stable are those contracts that you're currently in? If you've got good contracts that are really stable, then that's going to make you a less risky investment from our perspective. The more the less contracts you have, the more kind of fly by the seat of the pants, the more risky the investment and the higher the multiple. It's also the term of the payback, right? So most revenue-based investments are IRR driven. We're looking for a specific return to pay back our LPs, just like your traditional VC or PE fund. And so if we think it's going to take longer, we need to have a higher cap in order to hit the same IRR.
Okay, great. And you also mentioned, well, so when we talk about taking a percentage, obviously the more successful the business is, the higher return you're going to get. So what are the things that are non-financial related that you help the business in order to grow and really reach their maximum potential? Because if they're successful, then you have better returns.
Yeah, so we spend a lot of time upfront looking and understanding the use of funds. We feel like if you have a good knowledge of how you're going to use your funds, you're going to be much more successful in order to grow your business. And so bad uses of funds for us would be repaying existing debt, right? That's not going to help you grow your business. We want to see you going to buy another machine, or you're going to pay the slotting fees to get into that next grocery store, or whatever that is, increase your inventory for a traditional business because you need to sell through more. So use of funds is really important to us. We don't run an incubator on the side or kind of provide a system for helping people. I'm lucky in that my two partners are big traditional angel investors. And so they spend a lot of time hand-holding and helping our entrepreneurs if they need help. We're more of a call us if you have a question and we will help you, but we're not going to sit there and tell you how to run your business.
So you don't take a board seat or have any kind of formal involvement?
We have no formal involvement, right? We say, this is your choice, and we're not going to tell you how to run your life. We will give you advice. We'll make introductions if you ask for them. We do all that type of stuff that a traditional VC would, but we're not going to force that on you because we think that's actually a value prop for a lot of the businesses that we're investing with.
Okay. So why should a business owner go to revenue-based financing? Because in general, it is a more expensive cost of capital compared to bank loan, which is usually based on some flat interest rate. So what are the reasons why an entrepreneur want to go to RBF route?
Well, I always tell somebody, if you can get a bank loan without giving a personal guarantee, then you should do that every single day of the week. That's your cheapest source of capital. And we encourage all of our, everybody we look at to make investments within all of our investments to go do that, right? I mean, that's your cheapest source of capital. The reason to take revenue-based financing is fairly simple. Most entrepreneurs, by the time they hit their Series C, own about 15% of their equity because they've given so much up between their seed round, their Series A, their Series B to get to that point. So they don't own that much of their company. And if you sell your company for $10 million at 15%, you're not really making that much money. But if you do a revenue-based financing round, you suddenly knocked out one of those rounds of financing for yourself, and you've substantially increased the amount of equity you own. And for a lot of entrepreneurs, that's really meaningful. They don't want somebody telling them how to run their business, and they want to own more of it by that point in time, because then any type of sale is a meaningful sale for you. The more equity you own in your business at that moment of exit, the more you make. That just makes sense. And revenue-based financing, although expensive, is actually cheaper in the long run if you think about it as a percentage of equity ownership.
Great. And another question, I think timing, how fast can you get a loan is really important. With venture capital financing, easily 3 to 6 months and sometimes 9 months, and which takes away your time and the concentration from running and building the business. But revenue-based financing, my understanding is a lot faster, sometimes even faster than a bank loan. So tell us a little bit about the time frame, what it takes, and what documents that the business owner need to get in order to apply for RBF.
Yeah, RBF takes between 2 to 3 weeks generally with the bigger providers. It's a fast process, especially if you have already tried to do VC or banks and have your kind of ducks in a row. You're going to need your financials. You're going to need them monthly, generally asked for in Excel because somebody's going to have to manipulate it on the back end. So just export your QuickBooks. You want your tax returns. Everybody wants to match that up. They're going to look at your bank statements for the last 6 months because they're going to want to understand that the bank amount in your bank is actually what you're showing on your revenue, and customer contracts. Those are going to be the key things that people are going to ask you for. And if you have those readily available, it's a fairly fast process because from a revenue-based financing investor's perspective, If all those things match up, then you're a fairly safe bet for continued revenue going forward, and they're going to get paid back over a period of time.
Okay, and you, in your due diligence, I assume you actually contact some of the customers to make sure the revenue projection is real?
Yes, we do contact customers, and we do we do reference checks, that type of stuff as well. But that's, think of it as a traditional bank with a little bit more focused on the revenue versus on your net income on their balance sheet and your balance sheet.
Great, thank you. So we'll go to Shavonnah, and thank you for joining us from Southern Nevada. And so, you've been an educator, you taught entrepreneurship at UNLV, you've been a founder yourself, and being involved with a lot of the entrepreneurs. And as we all know, when we first started our own business, bootstrapping is really an important aspect of building that early stage. So tell us, what exactly is bootstrapping, and why bootstrap? What are the advantages of bootstrapping?
Awesome. All right. Thank you again so much, Grace, for inviting me today. One thing I want to ask the crowd, though, are you guys, just getting started, or you guys kind of already have a business? So if you're just getting started, maybe type a 1 in the chat or a 9 in the chat if you already have an existing business. Just getting started, James. Awesome. Me too. I have a new project coming up. Awesome. Hey, Maisha. Awesome. So for me, you're absolutely right. It is a great place to start when you're bootstrapping, and bootstrapping is just a way to say, I'm going to either invest in myself, allow my customers to invest in me, or find other ways and resources that don't necessarily require me to give either a piece of my company away or become indebted to a situation. Now, you could, of course, rely on credit cards, and a lot of people who bootstrap and do that, but that becomes your risk reward, right? How much and how early are you getting started, and how are you going to be able to kind of get to the next stage and what you're looking for, and really what type of lifestyle do you want? My next project is a SaaS company. I don't necessarily want to be in the VC game asking for people's permission to get money. I bootstrap. I had a client that I just wrapped up a contract, and I was able to really test out how to apply my software with them by just using spreadsheets and getting a reception on how they used it. And I was able to be like, all right, well, this doesn't work, this doesn't, this does. And then now I can actually apply that to the actual software I'm creating on the education front. So for me, bootstrapping is just a way to validate your idea, but then also make sure that you're spending your resources appropriately, especially if you're just getting started.
Okay, great. Well, what are some of the disadvantages or challenges of bootstrapping?
I think some of the challenges go in turn with finding your product market fit. For me, especially if you're working in software, or you're working in an industry maybe you haven't had a lot of experience in, or you don't have a lot of the mentorship or the allyship that you want to have just yet, it gives you a little bit of a disadvantage when you could possibly, visit Kelly or Molly and have access to some of the resources and partnership that they may have. It becomes a little bit of a solitary journey in some cases, but it's also the ability for you to figure out what's going on without having to take on, a lot of debt, to be able to, manage your expectations without possibly letting someone else down while you're still trying to figure it out.
Yeah. What if you are a first-time entrepreneur and you don't have a lot of credibility and you're trying to bootstrap, and how do you establish that credibility with your potential customers? Especially, you can't go around saying we are VC backed, even though that is also arguable whether that's really worth anything. But how do you do that? Establish credibility as you bootstrap and when you don't really have any backing?
I think one of the ways I just talked about, for me, I was able to work with a company who was actually looking for an employee, but I was able to take on a contract with them and be able to really say, hey, what are the things that you need? How can I apply my expertise to you and learn along the way, and still know that this is a limited term project so that I will still be able to continue with my project afterward. So that's one way. Consult. Fiverr, freelance.com, all these are really low barrier ways for you to actually test out your concept, especially if it's in software. And if it has something to do, I know a lot of friends who have food and beverage companies, they show up to festivals, They volunteer with other chefs. It's really about doing the minimal that you can to actually build relationships that are actually substantial. So you can spend, a few hours with someone, not just asking for, the brain dump that most people ask for, but asking how you can contribute, right? How can I actually help you with something so you can, one, build your relationship with them, but then also you can still at the same time build your own credibility in what you're doing.
Yeah, great. Thank you. So tell us a little bit about how you will build a bootstrapping culture, and sort of taking that minimalist approach, not spend money when it's not necessary, and have your team to sort of share your vision of that bootstrapping.
I think it starts with you first, right? So understand what your actual end game is and what your lifestyle choices do you want to have, right? Do you have this idea and notion that you want to have, a 500-person team tomorrow? Bootstrapping isn't going to grant you that, right? Bootstrapping is more of a foundational, I want to build this possibly with a small group of people, and I'm not afraid of the journey. I'm going to take a long haul, and I'm not afraid of that journey. So the culture really starts with you. Myself, you mentioned earlier, I used to run a business and startup center downtown Las Vegas, and we had a community of people who are all at all levels of entrepreneurship. So it was able to bring in people who didn't just focus on one type of business, let alone one type of financing to back their business, and be able to share kind of those resources. So if you're in the comment section, if you're here, try to meet someone else that's here so you can start building those entrepreneurial relationships. And then there's a lot of different foundations that I lean on. While, especially in the startup technology space, there's a lot of, emphasis on, becoming VC backed, getting investors, things like that. There's equally small groups of folks who, like indie hackers, who have their own resources, who have their own podcasts, and they're talking about how they're approaching their journey from their perspectives. So find those resources out there that can actually inform you, and you can share that with your team and share that with your potential investors. Most people say the 3 Fs, friends, family, and I'm going to call them folks. Most people call them fools, but those folks who believe in you, when you find those people, you start building a community who just believe in you, and they want to figure out how to make you succeed.
Great. So tell us what type of business are best suited for bootstrapping. Obviously, not all businesses are suited for that, especially businesses like biotech or some of the other, what I call capital intensive businesses, where they really need a lot of investment up front. In fact, biotech and pharma, and as well as oil and gas and gold mining, used to use royalty-based financing, and still are, and that's sort of revenue-based financing. That's how it sort of came about. But tell us what business is really best suited for bootstrapping.
Yeah, I think it's important to remember that about less than 1% of companies even get venture capital, right? So majority of the businesses that you know and love are being self-funded, bootstrapped, or have the 3 Fs, friends, families, folk, who are actually believe in those entrepreneurs. So majority of the businesses that the people on this call may want to start can absolutely be using bootstrapping, but bootstrapping doesn't have to be your last destination. It could just be your start. I know multiple people who have started the bootstrapping route and ventured off into the VC conversations because now they have leverage, right? They're not just asking for, hey, just put some money into a pot and we don't actually know where the bottom is. It's saying, here's the proof that I have. Now that I actually have a foundation, I can actually talk to Molly and talk to Kelly and be able to negotiate better terms for myself. And the same for Edward. So I think it's the ability to start somewhere and then grow it. So even if you did have like a pharma company, like what is the basis of your invention and what is it you're trying to go to? Because you don't have to go straight to FDA sourcing. You can actually do more to actually prove the efficacy just with your community.
Okay, great. Yeah, and then in fact, I think we sometimes forget that many of the very successful companies that we all recognize, like Apple, Dell Computer, Microsoft, and even Coca-Cola, they all started bootstrapping. In fact, Apple and Microsoft really had not only customer, but repeatable orders before they even thought about going to raise capital. So, well, thank you. So I have a couple of questions that I'd like to ask any of the panelists to address. How has the pandemic impacted financing for startups? both in the capital that you can source from your own investors, as well as the type of entrepreneur you look for, because now, you know, people may need a longer runway in order to grow their businesses. So just, you know, how has the pandemic investing world for you?
I think we haven't had a problem with access to capital. I know entrepreneurs out there have, existing businesses have, you know, we're looking harder at experience, really, especially, you know, we're not saying no to startups. Most people aren't doing startups. We are really just looking at the experience, the strength of your plan, you know, your management team, if the company is large enough that you're going to have a management team. That's what we're really looking at. And then we go from there. I don't know if any of the rest of you are having that experience.
Yeah, I don't think that we've seen a huge impact from, interestingly, we haven't seen a huge impact from COVID. We have a structured fund that our investors have already committed to, so that's not an issue on that end, getting access to the capital. And we did an investment 3 weeks into COVID to a company that was selling through the grocery stores, because you know what, those are actually going gangbusters right now. Nobody's eating out, but they're certainly buying more groceries. What has been interesting on our end is that companies are certainly moving more slowly in terms of, and being more kind of careful about their decision making, I would say, and that's never a bad thing for a company to be. I think you should be, you know, really cognizant of how the money you're taking is going to impact your business and impact your life long term, and what the best decision making is for you. And I think the benefit of COVID is that it has slowed people down a little bit and made them think a little bit more. And some of the best businesses come out of those type of recessionary or different, you know, kind of inflection points in our economy, because they do make people think a little bit more clearly about what is the goal of my business, what am I going to use my capital for, and what do I want to achieve going forward.
Okay, great. Kelly?
Just on our fund side, we do have a unique fund structure in the fact that we are a field of interest fund at the community foundation, so we're donation based. So we did see a difference from our donors, which in a normal fund you'd think of as investors. So we did see a difference when COVID hit, because obviously there were lots of amazing needs and help that wanted to go to some other areas. But we are seeing a refocus now on our entrepreneurs and rebuilding our economy, which is wonderful. Generally speaking, with the companies that we work with right now, from looking at investors, there's a split in the investor community that we have seen. One where they are very trepidatious and overly cautious to a point of detriment to even talking to companies. And then also really seeing that crisis is fueling innovation right now. And so that other side of the investor spectrum going, oh my gosh, this is amazing. Where can I put my capital? So we're seeing a definite split on the extremes right now.
Great, thank you. And Shavonnah, you know, for entrepreneurs right now, they're trying to bootstrap, but clients or customers may want to wait before they commit to a trial or commit to a product. What should the entrepreneur do in order to kind of get through this period?
I think regardless of, you know, where you are, whether or not you're gaining a lot of momentum, I think that Kelly just made a great point. You're going to have to prove yourself right now, right? The best businesses usually come out of a forced break. I know a lot of great businesses came out of the recession era when people were really trying to figure out what to do next, and the ability to just continue and churn, because if you can build that muscle to be strong and to endure now, then 2 years from now, you're going to take off like crazy. So I think the ability to just continue to go, to continue to build your network, figure out what you can do. Barter systems also work in times like this, figuring out how you can exchange resources with potential customers, but then also potential partners. Those things actually kind of help you build. And then you were mentioning earlier, you know, what if you don't actually have that backing? That's how you actually build that community, right? bartering, figuring out ways to help other people, figuring out ways to show your product in maybe, different ways. Like, I'm definitely going to QVC my product on Zoom, but I think it's the ability just to have that endurance just to make it through.
And Molly, and for our RBF, obviously, if you had done a deal maybe a year or two ago where the company is growing like crazy, revenues are doubling every month, and then all of a sudden there's a huge slowdown. So how do you manage that? Sort of keep the entrepreneur committed and help them to sort of get through this period.
Well, that's the beauty of RBF, because we're in it together, right? We took the risk that you were going to have the revenue growth, and then when it doesn't come through the way that all of us hope for, we're still got to work through to the end. And I think mostly from the customer's perspective or from the company's perspective is, we're taking less money than every month. And so that helps them because our payments went down, unlike your traditional term loan where you have a set amount that you're going to pay every month. The RBF payments declined because you didn't receive as much money from your customers. And it's just going to take longer to pay it off. And that's a conversation that you have closer to the end date. So most RBF investments are 3 to 5 years with a set maturity date. And if you're within 6 months of that maturity date, you're going to have a conversation about, hey, it doesn't look like we're going to hit that 3 months. We're going to hit the payment off in the next 6 months. Should we extend this another 6 months? Maybe that works for everybody because the returns are still good enough that it's not a big deal. Or do we come up with a one-time lump sum that allows us to get enough out that we can all walk away happy? Those are kind of the conversations you have closer to the maturity date at the end. But the RBF lender is in there with you because they took the risk that your business was going to grow. And with the slowdown in the economy, everybody's going to see a little bit less money coming into their pocket.
Great, thank you. So I think we'll open up for audience Q&A. So you can either raise your hand or submit the questions through the chat room. And you can direct the question either to a specific panelist or the entire panel. So while we're waiting for the question to come in, another question I have is this whole capital roadmap, capital stacking, if you will. And that is, you start off and you bootstrap, you get to a point where you have revenue, and then you're going to need, and then all of a sudden you have a potential for rapid expansion, and you might go for a bank loan or revenue-based financing, or you may go with the venture investors. So do you network with other capital sources so that you actually make sure your entrepreneur is successful and all the way to building a sustainable business?
Yeah, we do. I spend a lot of time with bankers, accountants, those types, a lot of time with other CDFIs. Some people might think that in the CDFI world or whatever, if there's another CDFI in town or in the region, they're competitors, but they're not, because we each have our own niche that we work in. And where I may not be able to do a deal or finance a deal, they may. And oftentimes we're passing, files around and trying to figure out how we can, get something financed, or sometimes we'll do it together. We'll participate in the financing together. It just kind of depends. The idea is not like a bank where we're working within certain parameters and you don't fit within that box. It's an automatic no. When you come to us, we're looking for a reason to be able to do this, right? Because our interest is to be able to do that financing, to give you that capital so you can do your business or grow. Our end goal is to eventually get you to be bankable, to eventually take you to a bank and go, okay, let's refinance this loan. Let's get you other kind of capital or investments. And so oftentimes we'll do a blend. I mean, I've done stuff where, I got them their PPP loan through Prestamos. We throw on top of COVID-19, SBA microloan on top of that. And now we're in an SBA 7A situation. And then, by the way, I happen to know some investors that are really interested in your company, even through this pandemic situation. They can see through your numbers were really great in 2019. We know it's a pandemic, has nothing to do with management. Let's talk. So, you know, we work with everybody.
Great. So maybe this is a good follow-up in terms of what is your metrics for success. And you talked about getting the company to a bankable entity, and obviously financial return for yourself. So how do you actually look at the success of your entrepreneur that you have invested in? Is it that they actually eventually being able to get to a bank or build a sustainable business? How do you measure that?
Well, there's several metrics, right? There's our own within the company, and then there's metrics that we report to the U.S. Treasury. Kind of depends. The biggest ones we look at is how many jobs did we create, right? At the end of the year, how many jobs did we create? How many clients were successful in paying off their loan or making on-time payments, and how many were we able to get to a bank and get them bankable, right? So let's say if we have somebody at a 7.25% rate, and through working with them, through the coaching, we've gotten their business to the point over the course of a year or two where, you know, our bank partners are actually competing for their business. That's a success, right? Because now all of a sudden I can put them in a 4% or 3.75% or lower type of loan. We've had clients that all of a sudden they started with us. Now when they're in the process of just purchasing their building,
Great,
you know, something that they never imagined they'd be able to do, they're all of a sudden doing a 504 loan and purchases building.
Great. We have a question from James Walker. As far as startup funding, what would the panelists recommend for a small home-based farm who wants to supply specific produce to restaurants, farmers markets, and consumer deliveries? So capital needed will be very low, 5 to 10K in the most ambitious models. What would you recommend? Any panelists?
I don't want to hog all the time up, but you know, USDA actually ran across this in Gardnerville, I think, and USDA has a really great program. I can't remember the name of the program, but for something like that, they've got a fantastic program. So if you go to the USDA website and you look that up, the folks in Carson City are super helpful. That would be a way to start. Otherwise, you know, something that amount, bootstrapping would be a great, you know, way to go after that. If that doesn't work, then, you know, I would look at one of our CDFIs. I'd look at, you know, somebody like Opportunity Fund or Dream Spring in Las Vegas. As you grow a little bit larger, you know, I'd call Prestamos, right? Or we cut off at $10,000. So we're $10,000 to $1 million. And on our new market tax credits, there's really no limit. But, you know, so I would look for those resources first. But I do know USDA has a great program.
Yeah, to add on to that, you know, there's a lot of types of bootstrapping. There's not just, you know, friends, family, folks, or credit cards. There's also, you know, equity-based crowdsourcing or crowdfunding, traditional crowdfunding where you just pre-order. You have people pre-order your product and then you deliver at a later date. There are a lot of different ways that you can engage your customers and have them take that risk with you as you produce their product in the meantime. So
thank you. We have a question from Kimberly Greenman. How do investors view companies that have relied exclusively on bootstrapping in the past when finally seeking investments?
I'll go ahead and start that off. That's fantastic. So bootstrapping in our eyes is not a negative at all. You've been working hard. You're scrappy. You can make things appear out of nothing. It really just shows the type of entrepreneur you are.
Yeah, I would echo that. Good for you. The problem is now when you go to find investments, it's a boys club and you have to know gotta know people to get introduced to them. So I would say join LinkedIn and see how many people you know who are one contact away from the type of investors that you're looking for, and use them for the connections, because investors rely on other investors to make decisions. They're kind of like sheep. That's terrible to say, but it's true. And so when you're out there looking for those investors, they want to know that you know somebody that they're potentially connected with. And that's probably your best bet, is to join LinkedIn and see where all your connections are that way.
Okay, great. And I think, you know, this may be a good time because everyone is well, it's in the middle of a pandemic, and a lot of us are working from home and no travel. And you could argue that investors actually have more time to listen to deals, or at least talk to you, and good time for networking. So maybe if all of you can share a little bit about what would be some of the good networking strategies in order to get yourself a good network of investors in all sorts of capital.
I'll start. So how I got into the startup environment was completely by accident. I wanted to start my own company in 2011, you know, somewhat out of college, working at a law firm, and found out about an event called Startup Weekend. And in that event, you essentially try to build a company in 72 hours with people from all types of walks of life and their own ideas, and you pitch it to investors on a Sunday. Right? You pitch it on Friday to get people to join your team. You pitch it to investors on a Sunday. So that events like that, those things automatically build your network. Now, in this COVID time, there are a lot of different resources, people on Slack channels, groups. So find those communities that speak to your specific industry or your type of, you know, goal in terms of the company, type of company you want to have, the type of funding you want to go after. And you can find all those different communities just by doing quick Google searches and putting Slack or Discord or podcasts at the end. You'll be surprised how many different resources pop up.
Kelly, you have something you want to add?
I think Shavonnah just gave a fantastic overview, and right now during COVID, the doors seem to be open a lot wider than usual. Use LinkedIn, say hi to people. Connections are happening rapidly and even way high up. I've seen people connecting with CEOs of Fortune 100 companies just because of the times we're in. So yes, reach out, attend events like this. I see the chats going crazy in a really positive way. Just reach out, say hi. Can we, you know, invite people to chat, brief Zooms, all of that, and just keep at it.
Great, thank you. And Molly?
Yeah, so I would say LinkedIn, but then also cold emails are getting returned, especially if you do some research on the person and the website before you send the cold email to the investor. So make sure that that they invest in your space. And a lot of people are very clear on their website about the size of the investments they're looking for, the type of investments they're doing. And if you're accurate and meet those criteria, people will respond to you, especially because of COVID. They're not doing anything else. They're on their phones all day trying to avoid their children, just like me. And so, you know, that is a good way to get in touch with people. And I think, you know, just do a little research before you send it. Don't send the same cold email to 5 people, because you figure that out pretty quickly. But if you're specific about, I saw that you invested in a company that's very similar to mine or in the same space, those things get people's attention and can really further the conversation.
And Kelly, I think you had another.
Yes, I wanted to just let everyone know on the call that if you have a business in the city of Reno, they just announced COVID grants up to $20,000 for existing businesses, and the grant closes on September 8th. Very close, very short, 1 week. There also will be an additional grant coming out specific to women and minority-owned businesses, again up to $20,000. So look for that announcement in the next couple of weeks.
Great, thank you. So we can take one more question. So if you have any question, you can send through the chat room. And after this, we will have recording. If you want to hear this again, let us know. And also, if you would like to have contact information for any of the panelists, let us know, and we'll, I assume it's okay with the panelists if, to send you emails. We do have one more question coming in. Where can we learn more about those grants? I assume this is the City of Reno COVID grant.
Go to City of Reno's website, which I believe is reno.gov. I might be a little off on that. At main page at the top, it says COVID resources, and just click on that and it'll go straight to their grants page.
Okay, great.
There's a lot of resources out there. What I would say is just be prepared to, with your P&Ls and taxes, those kind of things, because they are requesting them, and the faster you get that, the faster they can process things and approve things. You know, just through my experience with dealing with the city of North Las Vegas grants and other states, they're all, for the most part, asking for the same amount of things. The other thing is, you know, definitely get our contact information, call us. Love talking to people and hearing about different businesses. I've built everything from, you know, jet engines to worm farms, you know, so I just put my info out there. Call me, text me, email me, you know, and if I don't respond, then definitely text me. I've been having a problem with my email lately with a bunch of stuff going to spam, but just hit me up. I'm glad to answer any questions and push you in the, you know, send you in the right direction for resources as well.
Great. Well, it's 2 o'clock. I want to thank all the panelists one more time to share your insight. And if any of you wanted to connect with any of the panelists, let us know. And I just wanted to let everyone know our next forum for our speaker series is going to be in mid-October. We're looking at a panel discussion on the latest trends or the future of e-commerce in the area of specialty e-commerce, where the e-commerce company is selling specialty product and creating an affinity group. So it'll be an interesting discussion. Again, thanks everyone for attending, and thank you all the panelists for joining us. Have a good afternoon.